How hard is capital raising at the different stages as you're growing your business? It's a common question that most companies have. In this video, I'm going to be taking you through the different stages of raising capital and what you should expect from a difficulty level. Understanding that it's all difficult, but really what is the hardest and then what you expect during this period. So as mentioned, raising capital is challenging at pretty much all times, right? There's no one that I've ever met that says, "Wow, capital raising is just such an easy process. I just look forward to it every single time I'm about to go through it." It's pretty common. So one of the things, so when we're speaking with companies, they're always trying to understand how difficult is it going to be for them. And the reality is most companies are just trying to get some sort of level of confidence for themselves about their own process that they're about to go through. So here's some of the things, I suppose, some tips for you to understand what is the most challenging part, and then also what is going to how you should expect it to sort of flow from then on. So the first and most challenging part and the hardest time to raise capital is actually in the R&D phase. There's actually a reason why they call the triple F fund, right? The friends, family, and fools, right? The reason is because they're the ones that already typically like, know, and trust and respect you, or they're just willing to have a punt on what you're actually doing. So the research or the startup or the seed stage is the place where you pretty much have nothing in motion. You've got an idea, you've got a concept, and you're asking for people to back you on what you're actually doing. So that is actually the hardest stage to raise money, is right at that ideation stage. The next stage that we're sort of looking at, if you want to put into context, would be around that sort of, let's call it the commercialization stage. So you've got the idea, you've done the R&D work for it, you've now got a product, right? Let's call it, you've got your minimum viable product, and now you actually want to take it out to the market and see what sort of response you're going to get. So this is, technically this is sort of like an MVP slash commercialization. This would be the next stage, next level of challenging. So if R&D was a difficult, this is at hard, right? And the reason I highlight that is because the reason it's a bit easier is because at this point you're probably going out and you're looking to get money from either angels or high net worths to back what you're doing, right? If you're sort of a moonshot or an advanced tech company, then you may be going to VCs to have conversations about what you're doing at this stage. Now, the importance to understand this is to know that as you're going through it, the time frame should get less and less. It's still going to take long. It's still going to take good sort of, sometimes 3, 6, 12 months. But you've just got to be consistently in motion as far as speaking to investors and keeping them updated with what you're actually doing. So that's the second part. Okay, so hardest R&D, second commercialization or MVP to commercialization. The next stage that you're going to go through is typically a growth stage, right? So as you're going through growth, there's a different type of investor that you're looking to deal with that is going to be looking to back you. This is a bit level easier than trying to raise money at the commercialization phase. And the reason is because investors understand that when they invest into your business, it is going to the growth of the business. So effectively, what you're saying to the investor is that, okay, my product is proven. I've got clients. You potentially won industry awards. You've now got a board formed around you. You've got some key people in place to say, hey, this is actually a real business and we are growing, we are moving, we have things in action. So that's at the growth phase. Now, typically when you're raising money at this stage, you want to highlight different elements of those growth. So you may be highlighting different clients that you're working with. You may be highlighting, it's that job of how do you move something from unknown to known. And often that's the different elements of whether it be clients, whether it be board members, or whether it be even just growth rates that you're working with. Those factors make it really easy for you to communicate how investable your business is to a potential investor. Okay, so that's the third one. Fourth one is one that people don't often think about, but is actually an area which can often be easier for companies to raise money. And this is acquisitions. So if you're in the growth phase for your business and you start thinking to yourself, geez, I really want to accelerate that growth. There's two different ways you can do that. You can either throw money at your own, you can invest money at your own building your own business development team, or you can look to acquire businesses that are similar, relevant to your area, that you can potentially build off their networks and build off their ecosystem to grow your business. And often when you're going through an acquisition process, sometimes it's actually easier for investors to back investing into an acquisition, because you're effectively backing a known quantity. And the business that you're looking to acquire, you can provide information about that. Whereas when people are investing for growth, obviously what sort of growth you can achieve is unknown. But if they're taking that same capital and using that to acquire a business, the actual growth quantum is already known. And in fact, if they're looking to make acquisitions, there could be synergies across those two businesses, which means from an investor's perspective, they're thinking, well, there could be cost savings across those two businesses. More than that, they're thinking, well, if you can acquire, let's say, an additional 50% or 25% or 100% of revenue, then what they're going to be thinking, so well, if these two businesses join, maybe the revenue potential gets heightened, right? So that's where, so when we're looking at capital raising and companies ask us, oh, what do you think of this? What do you think of that? One of the strategies companies don't really ask too much is about, well, what do we think about raising capital to acquire other businesses? When actually for investors, this is it. It's a much easier quantum. It's a much easier idea for them to understand, because a lot of the quantums are actually unknown. Now, of course, there could be challenges with the businesses coming together, but effectively what they are looking to invest, there's certain known quantities associated to that. And then the next one that I'd like to talk about, so and this is obviously being an unlisted company, the easiest time that we have seen to generate interest for a business and to raise money for a business is one, actually when they've just raised. For some reason, it's easier to generate interest for a company after they've just closed off a capital raising. Actually, but the last one that I really want to highlight is that the pre-IPO stage, right? And I highlight this in a lot of the workshops I do, but effectively, for a company that's raising money, the reason why pre-IPO stage is easiest to raise money for, right, is the fact that there's a listing in sight, right? So there's an exit in sight. So the investor understands that there is an upcoming exit. But more than that, if you highlight that you're listing within a 12 to 18 month time frame, they're expecting that there's going to be some sort of uplift, right? So if they're investing at, let's say, for example, if they're investing at 15 cents today, their expectation is that when you go to IPO, it's likely to be 20 cents. So from their perspective, there's a lessened risk because there's an upcoming exit, right? And also there's an expected build-in to the actual price for when the company actually goes to IPO to raise a larger amount of money. So that's the 5 different stages that we sort of think about think about capital raising as an unlisted company. So when people ask for it, how hard is it to raise money? These are the sort of 5 different stages that we like to highlight. So just going to repeat through those again. The first one is obviously the seed, the R&D stage, when you're sort of trying to figure out if there's some sort of potential product or some sort of offering there. The next stage is the MVP to sort of / commercialization stage. The third is growth. Fourth is raising money to make acquisitions. And then fifth is raising money in sort of the pre-IPO stage, then go and list on an exchange. I hope that's been helpful for you. If you've got any other suggestions of content which you think could be of help to you in your capital raising, or at least just in general business, please feel free to ask us. We're always looking to provide additional value to our subscribers.